Welcome to the Money Answer Show with host Jordan Goodman. Whether you are starting out, deep into your retirement, or somewhere in between, the Money Answer Show has the know-how to help you. Now here's your host, Jordan Goodman.
Welcome to the Money Answer Show. This is Jordan Goodman, your host. My guest for the first half hour is Jay Hatfield. He is a fund manager at Infrastructure Capital Advisors, also known as EnfraCap, which has 3 exchange-traded funds in the master limited partnership and preferred stock area. Welcome to the Money Answer Show, Jay.
Oh, thanks, Jordan, for having me. I appreciate it.
Just give us a brief background of your experience in the financial field before you got to Infrastructure Cap.
Oh, great, thanks. So I started out as a CPA in California. I graduated with an MBA in finance from Wharton about 30 years ago. I worked in investment banking for about 15 years, mostly with Morgan Stanley doing utilities and MLPs, and then worked for 2 hedge funds doing utilities, MLPs, and credit. Most notably, I guess, would be SAC Capital Advisors at the time. And then about 12 years ago, I launched my own asset management firm. The first project I worked on was launching a MLP, NGO Energy Partners. And then after we got that public, I focused on the ETF business. And about 6 years ago, we launched AMZA, and about 3 years ago, PFFR, and about a year ago, PFFA, which are 3 ETFs. So that's
very good. Background. So let's just talk a little bit about the interest rate environment and how the MLP and preferred ETFs that you have kind of work in that environment. So interest rates have fallen quite a bit. In Europe and Japan, they're deeply negative interest rates. What are you looking for in the interest rate environment going forward? Are rates going to go even further and more deeply into negative, or what are you looking for in interest rates, say, the next year or so?
Well, just, I guess by way of background, for the last approximately 3 years ago, we've been saying that rates would be capped, which isn't super insightful right now. But the reason we said that they would be capped is that we did the research, and you can find great studies that there's 40 trillion of global pension assets. And the reason we were doing that research is we had thought that the aging population, particularly in the OECD countries, was creating sort of a short squeeze on pension funds where they need to keep funding the pension funds, rates are going lower, and those obligations are rising. So that was a good insight 3 years ago. We still think that that's true, not necessarily capped at 150 on the 10-year, but once we get well over 2% on the 10-year, we think there's a deep bid for bonds from those pensions because they need, particularly U.S. pensions, about 32 trillion is actually U.S. pensions. So they need that kind of risk-free, dollar-paying security. On the downside for interest rates, we believed, and we were saying this before Labor Day, that the U.S. market's a little different than the European market. First of all, we have much more free market capitalist system driven by technology, so we just have fundamentally a more dynamic economy, so there's higher needs for capital. And we also have a dynamic bond market. A lot of the borrowing in Europe is done through banks. So when rates go very, very low, our big corporations will take advantage of that, and corporations like Apple will just opportunistically issue bonds. And since those are investment-grade bonds, they're really a substitute for treasuries. So we really don't see rates going, even below 1%. And I guess the other related point, which also ties in the stock market, is that we think that we're more mid-cycle. For rates to go sub-1, we would think you'd have to have a recession. And we don't think we're going to have a recession, which we can talk about later, but that's really what would be required to have U.S. rates at least go below 1% in our opinion.
So this is not only true for pension funds, but this is true for individual investors. They're having a very hard time getting the income they need to keep their lifestyle going, even at 1.5% or 2% on treasuries. So they're looking for alternatives, and that's what you're offering with your ETF. So let's start off with the MLP, the Master Limited Partnership ETF, where the symbol is AMZA. So what is attractive about Master Limited Partnerships in the current environment? You have a relatively low oil price. Even when we had the attacks on the Saudi fields. Oil went up for a day, then came right back down again. Why would MLPs be attractive in today's market?
Okay. And I'm just going to focus on the sector as a whole, and people are welcome to go to our website if they want to research all the details about our ETFs. But in terms of MLPs, generally speaking, they're actually pretty well positioned, particularly relative to straight energy stocks, in that what they're benefiting from is moderate oil prices, so $50 to $60 is fine for MLPs. And what most people don't appreciate is there's an export boom going on right now out of the U.S., both natural gas liquids, which are produced when you drill for oil and natural gas, and then oil itself. Not because the U.S. is a net exporter of oil, but North America is. So oil comes from Canada and then through the middle part of the United States and then gets exported out of mostly Texas and Louisiana through three major ports. So MLPs are building all of the transportation infrastructure, the pipeline, storage, and docks that facilitate those exports. So their fundamental dynamics are extreme, very solid, good to great, but yet their stock prices are depressed because the last 5 years has really been extraordinarily difficult for energy investors because of the crash in oil prices, and then also a subsequent restructuring of the companies, which is very, very positive now, but not appreciated, in that now they have solid coverage of their dividends, modest leverage, and stable growth for most of the companies in the 4 to 5% range. So they really have and by the way, I would suggest those looking for those type of characteristics in all dividend-paying companies like utilities and REITs.
But MLPs tend to move more on the price of transporting oil and gas than the price of oil and gas itself. Is that correct?
That's correct. And in fact, recently, during the crisis, after 2015, the correlation with oil prices really went very, very high. It was almost 1. And as the volatility of oils declined and the volumes in the U.S. have increased, their sensitivity to oil prices have dropped dramatically, which makes sense because they are really like toll roads in that their cash flow is driven by the volume on their pipelines. But it's important to note that toll roads aren't risk-free, that if there's no traffic on the toll roads, of course, they're not an attractive investment. So MLPs need moderate oil prices kind of in the range they're in now to maintain drilling and even grow it slowly in the U.S., but they don't need $100 oil. $50 to $60 is a perfectly fine pricing environment for MLPs.
But the rig count has come down.
The volatility of them has dropped. Sorry, what was that, Jordan?
The rig count has come down recently with oil in the 50 range. Some companies have been pulling back, so that should mean less oil drilling and less supply going through the pipelines. Is that a worry for MLPs?
Well, certainly if the rig count continued to drop and drop more precipitously, a lot of the rigs that have been coming off have been more natural gas rigs. And so really the more likely scenario is we just have stable production. I think at this range of prices, stable production is more likely. And like I said, that's fine for MLPs. But we wouldn't really anticipate a precipitous drop in the rig count with prices where they are today.
So let's talk about the ETF you have in the MLP, the InfraCap MLP ETF. Again, the symbol on that is AMZA. What kind of yield is that offering, and what would be the advantage of an investor of doing it through the ETF as opposed to buying individual MLPs?
Yeah, so we normally don't get into a lot of the details, on the media in terms of our ETFs, but I could say that we do think that the index ETFs like ours, are attractive in that you get a diversified portfolio of securities, and we like to focus on the large cap ETFs or large cap MLPs because they're the ones that are more liquid, have better credit ratings, and also are benefiting from these large infrastructure build-outs. And then most ETFs in the sector are structured as corporations. And so instead of getting a K1, which is a complicated partnership return, one would get a 1099 from all the ETFs in the sector. So that then cleans up the tax reporting, and so it's just like a normal corporation.
Oh, very good. According to the material you put out, the latest yield was about 8.8%. Is that roughly in the range?
That's correct. The sector is yielding right around 8.8%, which is below what it's been in the past, particularly if you look at a spread to BBB bonds. And then also, even more importantly, a lot of other equity yield alternatives like utilities. I was a utility banker, as I mentioned, about 25 years ago. They used to yield 5, 6, 7, 8. Now they're yielding sub 3, and REITs are also in the 3s in terms of yield. So relative to other equity income alternatives, MLPs are pretty significantly undervalued.
Much higher. Very good. Okay, we're going to take a break. This is Jordan Goodman of the Money Answer Show. My guest this half hour is Jay Hatfield. He is the portfolio manager at InfraCap Capital Advisors, which offers some exchange-traded funds, the ones we've talked about so far, about master limited partnerships. After the break, we're going to talk about those relating to preferred stocks. We'll be back after this.
We're always talking business. Talk to an expert. Call now, toll free, 866-472-5790. That's 866-472-5790. Voice America Business Network.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Show. This is Jordan Goodman, your host. My guest for this half hour is Jay Hatfield. He's a fund manager at Infrastructure Capital Advisors. They have 3 exchange-traded funds. We've talked about the one on master limited partnerships already, which has an 8.8% yield. Now we're going to speak about those relating to preferred stocks. If you want to find out more about him and his funds, his website is infracapfunds.com. Welcome back to the show, Jay.
Great. Thanks, Jordan.
So let's talk about preferred stocks. First, just do a quick definition of what a preferred stock is and why would one want to buy a preferred stock over the common of the same company?
So preferred stocks are usually perpetual obligations, but they have a fixed dividend and they're senior to common. So and many of them are cumulative and have provisions where if there's no payment of the dividend, then the preferred shareholders get to elect a couple of directors, so they have protections that they get paid. So they're less volatile than a common stock of the issuer, yet there's a little or no upside, relative to par. So for investors who are looking to add more yield to the fixed income part of their portfolios, it can be pretty attractive. So you take less interest rate risk. It's about 15% correlated to interest rates, but you also get less common stock risk because they're senior. So usually the betas of most preferred stocks or their correlation is about 30% of the market. And since those two factors are offset each other in most normal markets, they tend to be relatively less volatile than stocks, but yet have significant distributions or yields that are higher than just buying treasuries or investment-grade bonds or muni bonds.
So the fund that you have out now, the ETF, which is called the U.S. Preferred Stock ETF with symbol PFFA, what kind of a yield does that have, and roughly what kind of industries are your preferreds located in?
Sorry about that. In terms of really just talking about the sector preferreds, if you look at the index, it yields around 6, so it's pretty significant. That's more than the high yield index. And then, funds, we have one fund that's fully diversified that tracks an index, and then we have another fund that's actively managed. We have another fund that tracks the REIT preferred index fund. One yields about 6, and the other yields about 7.5% on an SEC basis.
So let's talk about the non-REIT one first, which is a broadly diversified preferred, what are some of the industries that are most highly represented in that index and in that ETF?
Well, the broader index has a big concentration in financials, and then so the other, but our fund and many of the other ETFs that are actively managed would be pretty broadly diversified. So if you look at the issuer preferreds, there are mortgage REITs, there's industrials, MLPs, financials is what the index is dominated by. So active managers tend to be much more diversified than what would be in a just the passive index. It's mostly financials.
And you use some leverage to increase the yield, is that correct?
That's right.
So does that make it riskier to do that?
Correct, yes.
So is it going to be very sensitive to interest? I mean, lately interest rates have been falling, so I assume that would be good for that kind of preferred stock. But if interest rates were to rise, would that be a potentially large downside for that kind of fund?
Yeah, that definitely is a risk. And as I mentioned, though, it tends to be better for, hold on one second. It tends to be less sensitive to interest rates than other asset classes like treasuries and investment-grade bonds. So a reasonable rule of thumb would be about 15% sensitive to treasuries. So within normal bounds, preferreds would be relatively stable. Of course, if the 10-year goes to 4 or 5%, that would be a big issue, because if the index is yielding 6 and you go to 4 or 5, that's a problem. But if the index is yielding 6 and you go from 1.5 to 2, it's not going to really drive value that much. But it is important also to note that preferreds, if the stock market really, really unhinges like the fourth quarter of 2018, they'll be impacted as well. But in a lot of more stable markets, like for instance this year, where you've had the stock market up and interest rates down, preferreds have been relatively stable.
So it's really designed for somebody who wants income. So this PFFA, which trades on the New York Stock Exchange, is yielding about 7.5%, you're saying. And the price of it doesn't move that much, is what you're saying. Is that right?
Well, yeah, I'm just talking about preferreds generally speaking, that in most, in a normal market, they would be less volatile because the sensitivity to the stocks and the sensitivity to bonds are usually, bonds and stocks typically trade in opposite directions. So in other words, you have rising interest rate environment, oftentimes, stocks are also rallying. So those two factors tend to offset. It's only in extreme markets where preferreds would get dislocated. So rapidly rising interest rates, like we said, more going north of 2% or significantly above 2%. Or if the stock market's not just down a little bit like it was in May and August, but more like it was in 2018, then that would dislocate preferreds as well. So in a relatively normal market, they tend to be quite stable. But they're not as defensive as treasuries, which would actually trade up in a rapidly declining market.
Yeah. So your other exchange trade fund is the InfraCap REIT Preferred ETF, symbol PFFR, also traded on the New York Stock Exchange. So why did you create an ETF only for preferreds issued by real estate investment trusts?
Well, again, I think we didn't want to get into a lot of detail about all of our ETFs, but so people can go to the website. But generally speaking, we do think that REITs are solid credits and often have unlevered real estate, so that's a good protection for the preferred stockholder who is de facto lending money to the REITs. So we think, in general, REITs are solid credits.
And they've done quite well this year. As interest rates have fallen, REITs have done well. So the yield has been consistent. Right, the yield has been consistent around 6%. And has the ETF itself appreciated a bit?
You can, again, I would just have people go to the website to check that. But REIT preferreds have, significantly lagged the actual REITs, but that points out that they're really fixed income.
Yes.
So the upside is really kind of capped. That's kind of the good news is that that they're less volatile, but the bad news is that returns are often kind of capped at the coupon level. This is true for all preferreds. So that's kind of what you get with fixed income is more stable returns, but you don't get the upside. Like the REIT index for equities, not preferreds, has dramatically outperformed even the stock market this year. So you don't get that kind of upside, but you just get less volatility and stable income.
It's designed for income, basically, is what I'm saying. So
yes.
if people want to find out more, again, the website they can go to is infracapfunds.com. As far as REITs are concerned, people have been concerned that so much shopping is going online, Amazon and so on, that's hurting particularly mall REITs. Are you concerned about some REITs that are particularly in the retail area?
We do have, I don't want to pick on any in particular, but we are cautious in that about that sector. Some of the mall REITs have adjusted well and have moved more to a mixed-use model where there's hotels, condos, more entertainment, and less just pure shopping that could be affected by the internet. So, and also it's important to distinguish between strip malls, where there's mostly grocery stores. It's pretty difficult to order groceries on the internet. So it's not like every single mall REIT is terrible, but the traditional mall that's anchored by department stores is under pressure, so you have to do the analysis. But we tend to be underweight most of those traditional mall REITs anchored by, by the old line department stores.
So in about 2 minutes we have left, just summing up, you think that we're not going into recession, interest rates are going to stay relatively low, so preferreds and MLPs are going to be a good place for your money in the next year or so. Is that right?
That's right, and I think it's important just to cite one fact, which is that in the last 10 recessions we had, where we had an inversion in many cases, the average of the 10-year bond was 7%, and that was really precipitating a big recession in the housing sector. And today we have really the opposite, where we have almost all-time low 10-year rates, which is really providing a stimulus to the housing sector. So that's really why we think we're more mid-cycle and late cycle. And that's important because, if we are actually going into recession, there aren't that many asset classes that don't get hit. Really just treasuries and possibly gold come to mind. So it's important for investors to make that assessment if they're going to take on either stock market risk or a treasury bond risk.
Very good. Well, thanks so much. My guest this first half hour has been Jay Hatfield, co-founder and portfolio manager at InfraCap, and he has an MLP fund, which is the one AMZA, currently yielding about 8.8%. He's got a generalized preferred fund with the symbol PFFA, also traded on the New York Stock Exchange, yielding about 7.5%, and then he's got a REIT preferred fund, a symbol PFFR, yielding about 6% these days. Thanks so much for being a great guest on the Money Answer Show, Jay.
Great. Thanks, Jordan.
Thanks very much. We'll be back after this.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest for this half hour is Alpesh Pamar. He is the host of the Wealth Matters website. He also has a podcast called Wealth Matters. He's an entrepreneur who is also very big in the residential real estate market, and he's written a book called Resilience, Turning Your Setback into a Comeback. Welcome to the Money Answer Show, Alpesh.
Thank you so much, Jordan. I'm excited to be on the show.
So just briefly tell us, you've had an interesting career so far. Tell us how you've made it to where you are today.
Absolutely. So I immigrated from India about 19 years ago. I'm proud to call myself U.S. citizen now. I worked in the IT industry for a while. When I was laid off in 2009, I decided not to do any W-2 job, and I started working for myself. And about 5 years ago, I realized that I have been trading time for money. Of course, I read the Purple Book, the Rich Dad, Poor Dad, which spoiled me, and I realized that I need to start investing and make sure my money works for me and I'm not working for my money. So from last 5 years, I started investing in real estate mostly, but of course in a lot of other type of assets as well, and looked into real assets, and that's how we got connected when I read your book, Master Your Debt, and thank you for that book as well, Jordan.
Very good.
But yeah, well, looking back, pretty much I moved into the real estate space. I've been investing. I started helping my friends, and that's how the idea of Wealth Matters podcast was born, because I realized that there are so many like my friends out there who do not know about real estate. Actually, they don't know about any other investment philosophy other than Wall Street, right? Because that's what we have been taught from our employers, 401k, pension plans, whatnot, right? So that was my reason to start sharing what I have learned, so that everyone does realize that this is what they should start focusing on.
So let's talk about real estate. Why invest in real estate? And do you want to do multifamily or single family compared to investing in stocks? And as you say, what most people are used to. What is the advantage of investing in real estate that you found?
Absolutely. So three most important advantages I see in real estate, and that could be investing in residential space or even in office buildings, self-storage, mobile home parks, whatnot, that tenant pays down mortgage, right? So you take over the mortgage because you are able to leverage, right? That's the key. When you are comparing it to stock, if I want to buy stock, I have to pay all of the cost of that stock from my pocket. I'm not able to leverage unless I start gambling and playing with options and futures and whatnot, right? If I'm not doing that, then in that case, I have to provide 100% from my pocket, whereas in real estate terms, you can pay down just 20 to 30% and you start owning that real estate. And the mortgage could be paid by the tenant, right? So while you own the real estate, someone else is taking care of the property as well as paying down the mortgage. That's the biggest advantage I saw when I was comparing to all other asset types, right? And the second most important one actually is the depreciation. And not many your listeners or even I was not aware when I started investing that U.S. Tax laws allow us to depreciate the property, not the land. But so let's say you buy $1 million building and you have the land is allocated about 30% of the value, which would be $300,000. Then you can start depreciating the other $700,000 over 27.5 years. What that means is that, let's say my tenant is paying down the mortgage and I still have cash flow of $500 a month. That is $6,000 a year. You do not have to pay taxes on that $6,000 because you will always have a paper loss on your tax returns because of depreciation. So that's another key, because even if I'm making $6,000 or $60,000, there will always be depreciation loss on your tax return. So I'm able to take advantage of what I got from my property or my investment and reinvest. So that's pretty much the time value, right? That I'm able to take advantage of that money right now and not wait for till I sell or whenever, right? And the third,
how about single family versus multifamily? Which are the pros and cons of those?
Sure. So single family, it's very easy to get in, right? Because it requires a single, smaller loan or cash deal. Appreciation is tied directly to neighborhood growth. So if neighborhood is growing, if the economy is doing good, it's going to appreciate, right? And they're also easier to sell because you can sell it to an owner as well as an investor. So those are the advantages. But then when I compare it to multifamily properties have way more advantages, right? So once you get going, I always recommend people to start looking into multifamily, because multifamily will generate higher cash flow because you can scale it up, right? They have more control over value. The owners have more control over value, because if you bring the rents up, the property values go up. It won't matter how much the next door property has sold, because as long as your rents are more than close to market rent or more than the market rent, and you are able to do value add and bring the proper value of the property up, your NOI increases, and that brings up the value of the property. Economies
so how would you recommend that people get into multifamily? Since you prefer multifamily over single family, are you talking about like 4-unit apartment buildings or 20? What kind, and how do you get started? Since you got started in that, how could people who have not had experience get started in multifamily?
Sure. So one way is, of course, try to get in by yourself, which is really hard in multifamily unless you focus on duplex, triplex, or fourplex, because up to fourplex, you can get a Fannie Freddie loan on your name, right? When you go above fourplex, that's called commercial investing, and usually Fannie Freddie would not give you a loan if you have never done it, if you are not experienced. So that's when I recommend investing in syndication. That's how I started personally. I invested in a single family residence. Plus, I started investing with other big syndicators who knew the game, who were able to, get all the investors together, right? So someone who is getting started, that they have lack of experience, right? So that's always a good idea to go with someone who is an experienced syndicator or a resource in this field. Second, you will have limited financial resources, right? So because you cannot buy a property worth $5 million on your own, then you want to go in or with other syndicators who bring a lot of other investors together in the game, right? So instead of trying to put $500,000 or $1 million in the property, you are able to only put, let's say, $50K into the deal, and you are part of that syndication, right? So now you own a share of 200 or 300 apartment unit buildings, right? And it's 100% passive. That's the other advantage, because you do not have to do any work. It is like investing in a stock, but now you are investing in real estate, so you get all those benefits. Like tenant paying down the mortgage, depreciation, appreciation, etc. Even though you have invested in real estate passively.
Is that something that you help people do, is to find good syndications in multifamily?
Absolutely. That has been my focus, because I personally want to invest. So what I do, I vet the syndicators, and then I invest my own money, as well as I help other people invest with me.
And so how can they contact you if they want to find out what syndications you're going to get involved in, or how to help people do so?
Sure. So they can go to my website, www.wealthmatters.com, or they can email me, which is alpesh@wealthmatters.com. Let me spell it out for you. It's ALPESH@wealthmatters.com.
And Wealth Matters is MATRS. You're missing the T and the E, correct?
That is correct. I was trying to copy Twitter.
And so what is the minimum investment level for the syndications, and what kind of yield and long-term rate of return should people expect?
Sure. So now that the market has gone up, so right now I see minimum investment go from 50 grand to 100 grand, depending on the size of the deal. Because recently we did a deal where the deal size was 10 million, then the minimum was 50 grand. But I'm looking at another deal where deal size is 50 million. So now, the operators are looking for 100 grand minimum. And from the yield perspective, that's a good question, Jordan, because we do want people to compare it to stocks or whatever else they are investing in. Right now, I have been seeing the yield is about, or they call it as preferred return, is about 7 to 8%. And over 5-year period, annualized return, you are looking at between 14 to 16%.
Very good. And what is the holding period that people should expect for these things?
On average, 5 years. Sometimes they are able to, if the property values go up significantly because of the value add or full-on rehab they have done, you can get out in 3 years. But I would say, it's about 5 years.
So the syndication is one building, one multifamily building. It's not several buildings. Is that correct?
No. So now you exactly know the asset. It's not like a fund where you put money in a fund and the fund goes and buys, multiple buildings. In this case, you are able to evaluate the location, the, purchase price, etc., as well as that particular asset, right? And that's why I prefer that instead of investing in a fund where they go and buy 10, different buildings or asset types.
Yes, very good. Okay, we're going to take a break. This is Jordan Goodman of the Money Answer Show. My guest for this half hour is Alpesh Pamar. He is the host of the Wealth Matters podcast on the Wealth Matters website. You can find out more at Wealth Matters, spelled MATRS.com. As you can see, he also helps people invest in real estate. We'll be back after this.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this half hour is Alpesh Pamar. He is the host of the Wealth Matters website and podcast. He's also a real estate entrepreneur. And his website is Wealth Matters, spelled MATRS.com. Welcome back to the show, Alpesh.
Thank you, Jordan.
So we talked about real estate, but some other ways to save on taxes relating to real estate. One is called a 1031 exchange. Why don't you explain what that is?
Sure. So real estate, of course, as I explained, is a good way to grow your wealth, but it also gives you a lot of tax benefits. And one of them is 1031 exchange, that once you have used that property and now you're about to go buy a bigger property, let's say you started with a single family, now you want to buy a multifamily after 5-10 years, you can pretty much, you do not have to pay any capital gains. You can pretty much take the entire gain and buy another building by using something called 1031 exchange. And there are certain 1031 exchange operators available. Pretty much they keep the money when you close it. It's like escrow company. And then when you're ready to buy, you can use that money to buy a bigger property. It could be multifamily, it could be self-storage, mobile home park, any kind of investment. Of course, there are some caveats you have to keep in mind, that you need to identify the replacement property within 30 days and you have to close on the replacement property within 180 days. But pretty much you do not have to pay any taxes, and that's what I have seen a lot of the celebrities, the big wealthy guys have used this strategy for years. It's also called that 1031 till you die, so that your heirs can get a step-up basis and they do not have to pay any taxes. So you can
you keep moving it forward. And so you never have to pay capital gains. And as you say, when you die, you get a step-up basis. So you would have gotten income all those years, but the appreciation on the real estate would, in effect, never be taxed, is what you're saying.
Exactly.
Yes. Another thing you say is to invest in opportunity zones. That's a relatively new tax opportunity. How can you do that, and how is that profitable?
So opportunity zone is very interesting. I would call it as 1031 on steroids. Because now for opportunity zone investing, that's a brand new from the Trump tax law, right? That you do not have to put money from same asset, right? So you can pretty much take your gains from, let's say you invested in Bitcoins or stock market and put it in an opportunity zone real estate. An opportunity zone, what that means is that there are certain neighborhoods which have been identified as opportunity zone areas where neighborhood is gentrifying, or the government wants you to invest so that to fasten up the economic cycle over there, right? So if you invest in, and the only way I have seen it to invest in opportunity zone is, of course, you can do it by yourself. Same way, it's going to require significant amount of capital, or you can invest in an opportunity zone fund. Right.
And what are the tax benefits you get from investing in an opportunity zone? So
it's pretty much similar to 1031, but much more, because you can take the entire gain from your from the real estate or stocks or whatnot, put it in an opportunity zone fund, and you do not have to pay any taxes on the gain till the opportunity zone or the property which is in opportunity zone you have invested in is sold. And on top of that, if the property is capped for 10 years, you do not even have to pay taxes on the gains which were generated from that investment in that property, right? So you have significant amount of tax benefits.
And is this something you can help people find, an investment in an opportunity zone?
Yes, absolutely. I recently invested in one of the opportunity zone fund.
And again, what's the minimum and the hold time to expect on something like that?
So that's opportunity zone fund it's interesting because they allow you to bring gains from any kind of asset. Usually there is no minimum. Pretty much you can start with around 10 grand and go up to, whatever amount you are comfortable with.
Yes, very good. Another thing you say is to do a monetized installment sale. How does that work, and why is that advantageous?
So that is the third option where you can pretty much sell your property as an installment sale, right? So you will have a certain LLC or a trust in between. So when the property is sold, and I'm in San Francisco Bay Area, you are in New York, people have seen double, triple the gains over just last 5 years, right? So I just saw an example where one of my friend had a gain of about over $1 million, and he sold the property on installment sale, and now pretty much instead of paying tax on that $1 million, he's getting that money as an installment. So every year he gets certain amount of money, let's say 50 grand. That will not move his tax bracket up, and he does not have to pay the significant chunk of tax right away. Of course.
So they're spreading it out. It out for many years and lowering the tax burden, basically.
Exactly.
Yeah. And the last thing you say is owner financing, seller carry. How does that work for profitability in real estate?
So that is pretty similar to monetized installment sale, where now you are financing the property, you become the bank, and you are carrying the note, right? So the property I'm selling now, I become a bank, and the buyer pretty much makes me the payment. So now I'm getting literally mailbox money, and if the buyer stops paying, I can take over the property, which I already knew about, right? This property, I managed it for the years, so I already know about what to do with this property. So I become the bank.
Do you recommend buying property only in the area where you are so you can go inspect it, or can you buy it anywhere around the country and have a management firm take care of it?
That's a great question, Jordan. I personally believe that live wherever you want and invest wherever it makes sense or the numbers make sense. So because I live in San Francisco Bay Area, I do not invest at all in California. I have been investing only out of state in different markets. So I definitely believe that you have to make sure there is positive cash flow wherever you are investing.
We have about 2 minutes left. Just kind of wrap it up as to what opportunity you see for people who've not had experience in real estate before to get into real estate investing now.
This is still a great time because real estate market does not move at the same time, even though the market has cycles. So of course, start exploring, start learning about real estate, and reach out to people like Jordan, myself, and even there are a lot more other educators or mentors out there. Reach out to them, learn as much as possible, and even invest with them. That way you'll be able to make your money work for you, as well as you learn from them and on how they are running the business, how they are managing the asset, etc. I would say this is still a great time to invest in real estate.
And tell people a little bit more about your podcast. What can they hear at Wealth Matters podcast? Yes.
So Wealth Matters podcast focuses on building long-term wealth. Of course, as I am a real estate investor, 34%, or I would say 70% of the focus is on real estate. But I had Mr. Jordan Goodman on my podcast to talk about how you can keep most of the money you make with you by using HELOC strategy and a lot of other strategies. So my podcast is all about building long-term wealth.
Very good. My guest this hour has been Alpesh Pamar. He is the host of the Wealth Matters website and podcast, which you can find out more at Wealth Matters, spelled MATRS.com. Thanks so much for being on the Money Answer Show, Alpesh.
I appreciate having me on your podcast. This means a lot to me. Thank you so much.
Good. Thank you so much, and we'll be back next week with another edition of the Money Answer Show. Goodbye for now.
Thank you for joining Jordan Goodman and the Money Answer Show. If you have a question for Jordan, please visit his website at www.moneyanswers.com. And be sure to tune in every Monday at 12 p.m. Pacific Standard Time right here on Voice America Business. See you next week.